So in the last video, we focused on how we measure money, distinguishing between M2 and M2 money supplies. And we saw a significant portion of our money is not physical cash, but it's electronic entries into bank accounts, which leads us to the next topic here, which is what role banks play in our economy. Banks are a lot more than just places to store money. They're actually really important, and they're central to how our economy functions and how money itself is created and managed. So our learning outcomes, we need to explain how banks act as intermediaries between savers and borrowers, evaluate the relationship between banks, savings and loans, and credit union institutions, and analyze the causes of bankruptcy and recessions. There's a famous story about the bank robber Willie Sutton, who, when asked why he robbed banks, reportedly replied, "Because that's where the money is." From a modern economic perspective, Sutton was both right and wrong. He was wrong in the sense that the vast majority of money in our economy doesn't sit in a bank vault waiting to be stolen. Instead, it exists as electronic records on computers within the banking system. Think about your own checking account balance. It's just a number on a screen. There's not a pile of cash with your name on it. But Sutton was profoundly right in a broader sense. Banking is intimately interconnected with money, and by extension with an entire economy. Without a functioning banking system, our modern economic life would grind to a halt. If I had more time, man, I'd love to talk more about the history of all that too, because it's fascinating when you think about how money evolved as a medium of exchange throughout the Renaissance era and how that helped, how accounting helped facilitate that. But I put a left on you guys. So we're not going to talk a history lesson. So how do banks facilitate our complex economy? Modern economies handle millions of transactions every day, from buying groceries to paying salaries, and they couldn't possibly function if everyone had to pay in physical cash. Imagine having to carry around thousands of dollars for a down payment on a car or a semester's worth of tuition. And that's where banks come in. They're a critical part of what we call the payment system, which is the mechanism that helps an economy seamlessly exchange goods and services for money or other financial assets. Banks allow individuals and businesses to store money in their accounts and then easily access those funds through direct withdrawals, checks, or debit cards. This makes transacting much safer and incredibly more convenient than dealing solely with physical cash. And beyond just making payments easier, banks play a role in reducing what economists call transaction costs. Transaction costs are essentially the expenses or effort involved in finding a willing lender or borrower. Imagine a world without banks. If you had extra money to save, you'd have to find someone specific who wanted to borrow exactly that amount and agree on terms. And if you needed to borrow, you'd have to track down someone who's willing to lend you money. And this would be incredibly time-consuming and inefficient. Banks solve this problem by acting as financial intermediaries. They stand between savers who deposit their excess funds and borrowers who need those funds for loans. Banks effectively pool the deposits from many savers into one large fund and then lend that money out to many different borrowers. This streamlines the process, making it cheaper and safer for both sides to engage in financial transactions. When we talk about banks, it's helpful to understand that they're part of a broader category called depository institutions. These are institutions that accept money deposits and then use those deposits to make loans. While commercial banks are perhaps the most common type, accepting deposits from the general public and making wide ranges of loans, they also have close cousins. Savings institutions, sometimes called savings and loans or thrifts, they've historically focused on housing-related loans, and for a long period, they faced federal caps on the interest rates they could pay to depositors. Then there are credit unions, which are distinct because they are nonprofit, member-owned cooperatives. Membership is typically restricted to a certain community or group, and they primarily make loans back to their members. While there are fewer banks than there used to be due to mergers and failures, credit unions have actually seen significant growth in their total assets, partly fueled by movements like the Move Your Money project that encouraged people to shift their deposits away from large commercial banks around 2009. So let's visualize how banks function as financial intermediaries. You can imagine a continuous flow. There we go. Imagine a continuous flow. On one side, savers place their deposits into banks. In return, they receive interest payments on their savings and they can withdraw their money as needed. On the other side, borrowers receive loans from these very same banks and they repay these loans, typically with interest. The banks, in turn, use the money from loan repayments to facilitate withdrawals for savers and to pay them interest. So the bank is essentially the hub in this financial ecosystem, efficiently channeling money from those who have it to those who need it, ensuring that both sides benefit and that the economy's financial capital flows smoothly. To understand how a bank operates, you need to look at its balance sheet. You should have all had an accounting class by now, hopefully mine, but just as a reminder, a balance sheet is an accounting tool that provides a snapshot of a firm's financial position at a specific point in time. It's divided into two main categories: assets and liabilities. Assets are items of value that the bank owns or that are owed to the bank. These can include physical cash, money held at the Federal Reserve, the loans it has made to customers, and the bonds that it's purchased. And on the other side, liabilities represent what the bank owes to others. The primary liability for a bank is its customer deposits, because the bank owes that money back to the depositors on demand. And then finally, the bank's net worth, also referred to as bank capital. You can think of it as equity, but it's bank capital. That's simply calculated as total assets minus total liabilities. For a financially healthy bank, net worth will always be positive. Economists often use a simplified version of the balance sheet called the T account because of its distinctive T shape. You've seen this before if you've been in my accounting class. The vertical line separates the bank's assets on the left from its liabilities on the right. So if we consider a hypothetical safe and secure bank, its T account might show $5 million in loans to customers, $4 million in US government securities, which are a type of bond, and $2 million in reserves as its assets. We'll talk more about this reserves thing here. On the liability side, it would list $10 million in deposits, which is money that its customers have put into the bank and which it owes to them if they ever ask for it. And to make the balance sheet balance, the net worth, assets minus liabilities, is included on the liability side. So in this example, with $11 million in total assets and $10 million in total deposits, the bank's net worth is $1 million. This positive net worth indicates a healthy financial position for the bank. So let's elaborate on the major asset categories for a bank. Loans are typically the largest and most profitable asset for banks. These can range from mortgages for homes to car loans to business lines of credit. These loans generate interest income for the bank. Banks can also sell these loans, which is kind of a weird thing to think about, but they can sell those loans in the secondary loan market, where the price they get for a loan depends heavily on the perceived riskiness of the borrower and prevailing interest rates at the time. Another key asset is bonds, especially low-risk U.S. Treasury securities. Banks will purchase these U.S. Treasury security bonds, and that provides to them a steady, modest stream of income. And then finally, reserves represent cash the bank keeps on hand, either in its vaults or as deposits at the Federal Reserve Bank. These are held to meet daily customer withdrawal demands and to satisfy the legally required reserve ratio that's set by the Federal Reserve. On the other side of the balance sheet, customer deposits are the primary liability. Now, that might seem a little counterintuitive to you as an individual, since it's your deposit to you is an asset. I deal with this in my accounting class too. When you think about a deposit from a business's point of view, that money in your business checking account, that's an asset for you. That's cash on your balance sheet, and cash on your balance sheet is an asset. And when you get your bank statement and you see this thing called a credit memo every time you spend that cash, well, I don't want to get into debits and credits with you right now, but there's kind of a disconnect there. What's important is from the bank's point of view, from the bank's perspective. When you put money into the bank, they have to owe you that money whenever you ask for it. So it's a liability, not an asset. They can use that money like it's an asset to sell loans. But the money itself, in your account, if you want it, you can go and demand it, which means it's a liability they may have to pay back to you in the future. So deposits are on the right-hand side of that T account, right-hand side. And as we discussed, the last component, net worth, is also recorded on the liability side. And that's because It's something that it's not because it's something the bank owes in the traditional sense, but rather it's just an accounting convention. This whole idea of balance means the left side has to equal the right side, debits must equal credits, and that's just how it works. And you should already know this. So I'm not going to spend a lot of time on this. For a bank, though, a positive net worth signifies financial stability and health. Federal Reserve mandates that banks keep a certain percentage of their depositors' money on reserve, either in their vaults or at the Federal Reserve itself, and this is called the reserve requirement. The difference between a bank's total assets and its total liabilities is its net worth. For a financially sound bank, that should be positive. But if a bank's net worth turns negative, it means its liabilities are starting to exceed its assets. In that kind of scenario, if all depositors tried to withdraw their money, the bank simply wouldn't have enough assets to cover all of its obligations. In that condition, where a bank has a negative net worth, is what we refer to as a bankruptcy or insolvency. So, how does a bank become insolvent and face bankruptcy? The common cause is a sharp and unexpected rise in loan defaults. While banks always account for some level of defaults in their planning, a significant increase, particularly during an economic recession, can shrink the value of their loan assets dramatically. For instance, if our hypothetical safe and secure bank experienced a wave of defaults that caused its $5 million loan portfolio to drop in value to, say, $3 million, then its total assets would fall to $9 million. Since its liabilities, its deposits, are still $10 million, its net worth here would become negative. So when a bank's net worth turns negative, it can't repay all of its depositors, which can force it to close, or it can require a rescue by external entities like the federal government. A clear illustration of this vulnerability occurred during the 2008 financial crisis. Many banks made mortgage loans, and then they engaged in a practice called securitization, where they bundled these mortgages into more complex financial instruments known as mortgage-backed securities. The idea here was to diversify their risk by spreading all these different loans into a single security that could then be purchased by many different investors. However, some banks became a little less diligent in their lending practices, making risky subprime loans and famously even what we call ninja loans, those to borrowers with no income, no job, or assets. When housing prices began to fall after 2007, which in their defense, that had never happened before, so it was kind of a weird thing, right? All these mortgage-backed securities plummeted in value. Banks that had invested heavily in them saw their assets decline drastically, leading to a wave of failures. From 2008 to 2011, 318 US banks failed as a direct consequence of this crisis. Another significant risk banks face is called the asset liability time mismatch. This means that a bank's liabilities, primarily its customers' deposits, are typically going to be short-term, meaning that depositors can withdraw their funds instantly or with very short notice. However, many of a bank's assets, like long-term loans, like a 30-year mortgage, and their bonds, they mature only after many, many, many years. So this mismatch between customers who can ask for money right now and you, the bank, who has money tied up for years, this mismatch creates a bad situation sometimes. For instance, if market interest rates start to rise, depositors are naturally going to seek higher returns. So they're going to take their money out of their bank checking account and into the stock market, or they might take it and buy a certificate of deposit or buy their own treasury securities, whatever it may be. If interest rates are rising, that means that money needs to be put to work so that they can earn some interest on it. So less deposits at the bank. To retain those deposits, the bank might have to raise the interest rates that it pays on things like its savings accounts or its CDs. But if the bank is stuck with a portfolio of older, lower interest rate loans that it made many, many years ago, it could find itself paying more in interest to its depositors than what it collects from its borrowers. And that situation, if it's prolonged, is unsustainable, and that can quickly erode a bank's profitability and its net worth. So how do banks protect themselves against these inherent risks like high loan defaults and the asset liability time mismatch? One strategy is diversification. Instead of concentrating loans in a single industry or geographic area, banks lend across various sectors and regions. This way, if one area experiences an economic downturn, then the bank isn't as severely impacted. Another strategy is asset sales. Banks can sell some of their loans in the secondary loan market and instead hold a larger proportion of their assets in more liquid and low risk forms like government treasury bonds, or just keep them as excess reserves. Speaking of which, maintaining excess reserves, which means keeping cash held above the minimum required amount, that gives them a little buffer against unexpected withdrawals or loan defaults, especially during uncertain economic periods. We're going to talk more about that in the next section because that's kind of also got some downsides. But applying these risk management strategies, banks are aiming to preserve their positive net worth even when facing challenging economic conditions. All right. So, like I said, in the next section, we're going to talk about how banks create money, but that specifically is going to also include a lot of conversation about the reserve requirement in terms of, how much money can they create. So we will deal with that in the next one. I'll see you then.